Good evening once again. In our last class, we commenced short-term decisions, and then under short-term decision, we discussed deleting of a segment. We said that deleting of a segment will arise uh, when a particular segment is operating at a loss. Therefore, the decision to discontinue the segment will need to be analyzed critically in two perspectives. One is to consider the economic angle of the decision that is to be taken. Then the second part is the qualitative factors associated with the segment to be deleted. All right, we discussed that all relevant concepts, including the qualitative factors to be considered. Of course, we also had illustrations to support our discussions. So today we are going to be looking at make or buy decisions. All right, it's also part of short-term decisions. So what do you understand by make or buy? All right, of course, under this, again, after explanation of the concept, we are going to try illustrations to be sure that we drive home all the points that we are going to be discussing. All right. So, what do you know by make or buy decision? Yes. Generally, in an organization, management may be thinking or management may be contemplating on whether or not a particular raw material, sub-assembly, or the component required for the manufacturing of the company's final products should be produced internally or contract to an outside supplier. This kind of a decision can be said to be critical as well as a strategic, especially in a business environment where competition is highly stiff. Therefore, it is strategic in the sense that there is need for the company to protect, okay, the proprietary or technological innovation embedded in its products. All right. So not only that, every product is unique. All right. So the company may need to protect the degree of secrecy underlying its product, because if a competitor is able to get hold uh, of the proprietary information or technology underlying the products, then the company may be out of business, because if your competitor will blend it, will improve on what you have done previously, and then they become better. Before you know it, the company will be out of business, and that's why you must ensure that you protect the degree of secrecy underlying your product. All right. So that is introduction to make or buy decision. Now, when it has to do with make or buy decision, we are going to analyze the situation in two different angles. We are going to consider the economic angle as well as the non-quantitative, the non-quantifiable factors relating to make or buy decision. Okay, under the economic angle of make or buy, the most important thing to do is to compare the supplier's quotation with the relevant cost of making the components, whether it will result in a saving or deficit to the organization. I repeat, whenever you want to carry out the economic analysis under make or buy, the most important thing that you need to do is to compare supplier's quotation versus relevant cost of making the components, whether it will result in a saving or deficit to the organization. Of course, the formats that you have here can be used to prepare the saving or deficit from making the components. The first item would be the supplier's quotation. All right. As a company, you want to know whether this component that you want to produce, you want to know whether you should make the component internally, all right, or you should contract it to an outside supplier. So, like I said, this decision, we are going to look at the economic angle of it. So to do this, you need to compare the supplier's quotation. How much is the external consultant or external supplier is willing to charge us? We collect that, then we compare with internal cost. If as a company you want to make the components by yourself, how much are we going to incur? Therefore, what are the relevant costs? Of course, you are going to consider direct material, direct labor, direct expenses, variable production overhead. We consider in case if there is any opportunity cost. Not only that, it is possible you may have direct, incremental, attributable, or specific fixed cost. Whatever the relevant cost, you had all of them together. So that will give you the total relevant cost. You then compare this total relevant cost with the supplier's quotation, whether we are going to have a saving or deficit to the organization. So that will take us to the decision rule under make or buy decision. Okay. The first one is that if the supplier's quotation is greater than the relevant cost of making the component, our decision will be to make the component internally. 2, if supplier's quotation is less than relevant cost of making it, then it is profitable. It is more profitable to buy from the outside supplier. But what if the supplier's quotation equal the relevant cost of making the component internally? Then we need to consider other, the company can either make or buy the component depending on other qualitative factors. All right, depending on other qualitative factors. So these are the decisions you need to take in relation to make or buy. I repeat it. As far as make or buy decision is concerned, the most important thing that you need to do is to compare supplier's quotation with the relevant cost of making the component, whether it will result in a saving or deficit to the organization. Okay, and we said that if supplier's quotation is higher than the relevant cost of making, it's better to make, the company should make. But if supplier's quotation is less than relevant cost of making, the company should buy. Where you have where the supplier's quotation and relevant cost of making are equal, then the company can either make or buy depending on other qualitative factors. So at this point, this will take us to the second aspect, the second perspective of the decision, which is the qualitative factors. So what are the underlying qualitative factors you need to take into consideration as far as a make or buy decision is concerned? Now, on the day of your exam, whenever you want to state your qualitative factors under make or buy, you are going to divide it into two. One factor, you consider the aspect of if you want to make as a company, if you want to make the component internally, what are the factors you need to take into consideration? The second part is that if you want to contract it to an outside supplier, what are the qualitative factors you need to consider? So both of them, you match them together. So if you can give like minimum of 5 factors to the examiner, then that means you are good to go. All right, you are good to go. And remember what I told you last time, it is not sufficient to just memorize all the qualitative factors that you have in your study material. All right. On the day of your exam, you are expected to link it. You are expected to relate it with the question. Don't make it open. Don't make it too generic. Okay. So that is that. Now, what are the qualitative factors you need to consider? Let's say, for example, you want to consider the internal factors. All right. Say you want to produce a component. First thing first, we need to ask ourselves as a responsible organization, do we have the requisite technical know-how or expertise to produce the component? It's a question that we must provide answer for. Because if you want to produce, you must ensure that you have requisite knowledge and expertise to produce it. So if you don't know, if you don't have it, that means you don't have the capacity to produce. Okay, that is for that. And that's what I've stated here. Do we have the requisite manpower? Okay, that's for the other one. That one is another thing. So the one I just mentioned is this one. Do we have the requisite technical know-how or expertise to produce the component in-house? All right. So if you don't have it, then it's better to contract you to those that are endowed with the requisite knowledge and experience. Okay. Then two, also, as a company, as a responsible organization, we need to ask ourselves if we have the required manpower to manufacture the component in-house. All right. So we want to know whether we have the required manpower. How many laborers do we need? Do we have them available, or do we need to employ or engage, okay, internally for us to be able to produce the component? So all of this, you need to consider it. Not only that, okay, as a responsible company, you want to ensure that you stay within the law, you obey the law of the land. Therefore, you need to ask yourself as an organization, are we permitted by law to manufacture the component internally in addition to the final product? Again, it's a factor that you must consider and then provide an answer for. Then, not only that, earlier when I was introducing the topic, this subtopic, I mentioned to you that, okay, there is need for the company to protect the degree of secrecy underlying its product. It's also a factor. So the need to protect the degree of secrecy underlying the company's products will need to be considered. All right. Even though I'm not sure you have it as part of the item I listed here, but again, it's a factor that you must consider. All right. The need to protect the degree of, let me add it. All right. The need, push it up. The need to protect, okay, to protect the degree or to protect the technological, is that either you call it degree of secrecy underlying the product, or the degree to, I mean, the need to protect the proprietary information, proprietary information or technology, okay, proprietary information or technology underlying the company's products, okay? Because if you say you want to contract it to an outside supplier, and then maybe you have been producing it before as a company, now that you want to contract it to an outside supplier, that means you have to give out what makes your product to be unique. So that's the degree, something that makes your product to be unique is the degree of secrecy. And you know that once you give it out to an external person, there's likelihood that you may not have 100% control over the usage of that technology, innovation or information. Therefore, you must ensure that you protect, in order to protect it, it is better whether you want to make it internally. All right. If you still continue to, if you want to decide that finally you want to give it out for external person to do it on your behalf, then you must ensure that that person is reliable. Okay. So we are coming back to that. So again, as part of internal consideration before the final decision is taken, the company will also need to consider the need to maintain better quality control, okay, better quality control of the product, okay, better quality control of the product. Oh, this is what I was looking for the other time. So the need to protect a company's proprietary for I match two things together in one, so you can separate it now. All right. So the need to protect better quality, to maintain better quality control of the product, of the component. All right. That's very important because maybe the company has been producing the component before. Customer are already familiar with the quality of your product. So if you want to give it out to external person to do it on your behalf, you must ensure that the quality of the component is top notch. All right. Otherwise, the company may stop buying your product, and then that's why you must ensure that you maintain better quality control of the product. So these are some of the factors you need to consider internally. What about the factors you need to consider whenever you want to contract to an outside supplier? All right. So look at it. You want to produce a component, you now say, okay, let me give it out to external company to do it on our behalf. So before you give it out to external person or to external company or external consultant, what are those factors that you need to take into consideration? The first one is that you want to ensure that the supplier is reliable. Therefore, you need to ask the question, do we have a reliable supplier who can deliver according to specification? Specification in the sense that as you want it, the design and then the look of your product or of the component. Do you have a supplier, a reliable supplier who can deliver according to how you want the design of your component to be? All right. So that's one factor you need to consider externally, okay? Not only that, you also need to ask the question, if the reliable supplier can satisfy the existing capacity level, okay? Can the reliable supplier satisfy the existing capacity level? You know, especially in our environment. If you say you need 100,000 quantity of the components, can you get it? That's the capacity. Can the supplier deliver the entire 100,000 quantity? Not that when you say you need 100,000, the supplier will tell you that we are bringing 60,000, 40,000 will come next hour or in the next day. That next day may not come until 1 week after. All right, and that will disrupt the business activity. So you must ensure that you have a reliable supplier who can satisfy your existing capacity level, especially if the component is critical to the normal business operation. So it's a factor that you need to consider. Not only that, you don't want a situation, you don't want a one-off arrangement with the contractor or with the supplier. So you need to find out, you need to ensure that the reliable supplier can offer a long-term arrangement. Okay, you need to ask the question, can this reliable supplier offer a long-term arrangement? So if yes, then we may consider outsourcing the production of the component to the external company. Okay, so these are some of the qualitative factors that you need to understand in relation to make or buy decision. All right. So now, before we begin our calculation, the primary purpose of make or buy are in two folds. Okay, the primary purpose of make or buy is to achieve saving for the organization, and two, to ensure that a reliable supplier is available to satisfy the requirements. Okay, I repeat, the primary purpose of make or buy decision is to achieve saving for the organization, and at the same time to ensure that a reliable supplier is available to satisfy the company's requirement. Okay, so that's that. So at this point, let's have illustrations to demonstrate what we have discussed so far. Let me know if you have any question before we proceed to calculation. Other than that, we're moving straight. I'll be very happy if I'm able to solve two illustrations today under this, so that in our next class, we'll move to special order. Okay? Yes. Again, you are going to solve illustration number 1 for me. All right? Go and solve illustration number 1 as an assignment. This is an assignment for you. All right? So ensure today is Tuesday. Ensure you submit not later than Friday. Yes, not later than Friday. I want to receive your solution on this. All right. So that is that. Let's move to illustration number 2. So we are going to solve illustration number 2 and 3. So that's my plan. We'll solve illustration number 2 and 3. So I need one of you to read illustration number 2. Who is helping us? Yes, Omawumi.
Okay. Yes, sir.
Go ahead.
Good evening, sir.
Good
Okay.
evening.
Dangote Edo Nigeria Limited produces and sells to wholesalers a highly successful line of summer lotion and insect repellent, has decided to diversify in order to stabilize sales throughout the year. A natural area for the company to consider is the production of lotions and creams to prevent dry and chapped skin. After considerable research, a product has been developed. However, because of the conservative nature of the company management, Shangotedo management has decided to introduce only one of the new products for the coming season. If the product is a success, further expansion in further years will be initiated. The product selected, called Sharp Off, is a lip balm that will be sold in a lipstick-type tube. The product will be boxed. Because of the available capacity, no additional fixed charges will be incurred to produce the product. However, a 100,000 fixed charges will be absorbed by the product to indicate fair share of the company present fixed cost to the new product. Using the estimated sales and production of 100,000 boxes of Sharp Off as the expected volume, the accounting department has developed the following cost per box: direct material, 3 naira; direct labor, 2 naira; total overhead, 1.5 naira; total, 6 naira 50 kobo. Shangotedo Nigeria Limited has approached a cosmetics manufacturer to discuss the possibility of purchasing the tubes for Sharp Off. The purchase price of the 24 empty tubes in a box from the cosmetics manufacturer is 90,000 or 90K. With this purchase proposal, it is predicted that direct labor and variable overhead costs would be reduced to 10% and direct material costs would be reduced to 20%. Required: should Shangotedo Nigeria Limited make or buy the tubes? Show calculation to support your answer. 2. What would be the maximum purchase price acceptable to Shangotedo Nigeria Limited for the tubes? Show calculation to support your answer with an appropriate explanation. 3. Instead of sale of 100,000 boxes, revised estimates show sales volume of 125,000 boxes. At any volume above 100,000 boxes, additional equipment at an annual rental of 10,000 must be acquired. Under these circumstances, should Shangotedo Nigeria Limited make or buy the tubes? Show calculations to support your answer. 4. The company has the option of making and buying at the same time. What would be your answer to requirement 3? If this alternative were considered, show calculation your answer.
Thank you very much, Wumi. Yes,
Okay.
that is the question. That is the question. In the first requirements, you are asked whether Shangotedo Nigeria Limited should make or buy the tube. Okay, so from this requirement, you should know that this question relates to make or buy. So without wasting more time, let me stop sharing this and move to the working note. Again, at your end, you can open to the material so that you can follow through. All right. Solution to illustration. 2, page um, that's page 35. Page 35. Okay. So the name of this company is Shangotedo Nigeria Limited. Okay. Number A requirements. Examiner is asking you, should Shangotedo Nigeria Limited make or buy the tubes? Show calculation to support your answer. And we say that under make or buy, the most important thing to do is to compare supplier's quotation with the relevant cost of making the component, whether it will result in a saving or deficit to the organization. So we want to prepare saving or deficits. So I will say saving or deficits from making the tube. Okay. So now at this stage, I'm at a liberty to use either par value or absolute value. Whichever of the two that I use, I'm going to get the same, I'm going to arrive at the same decision. All right. So if I choose to use power value, of course, I will always encourage you to use a power value because power value will be faster. Examiner can, except if you are told to calculate total. But other than that, so just use your power value and move on. That one is faster. So in this case, I will then come here. I want to compare supplier's quotation. So I will indicate supplier's quotation. So I will go to the question. Where is the section of the question where supplier is mentioned? When you look at the last paragraph after the table, when you look at the last paragraph, we are told that Shango Tedo Nigeria Limited has approached a cosmetic manufacturer to discuss the possibility of purchasing the tube for chap-off. The purchase price of the 24 empty tubes in the box from the cosmetic manufacturer is 90 kobo. All right, 90 kobo is the supplier's quotation, 90 kobo per box. So in this case, since I want to use power value, I will then come here. 90 kobo is the same thing as 0.90. All right, so that's that. Then I need to compare this with the relevant cost of making the tube. So relevant cost of making. Okay. So I'll then go back to the question. I need direct material, direct labor, direct expenses, variable overhead, opportunity cost. Any relevant cost that I have in the question, I have to consider it. So at this point, I will then go back to the question. Where are the direct costs given to me? From the table, you can see direct material, direct labor, and then total overhead. So let's pick it one after the other. The first one is direct material. Direct material is 3 naira. You can see that even that 3 naira is more than the supplier's quotation of 90 kobo. And that's why when you go back to the last paragraph of the question, you are told that with this, after that 90 kobo, you are told that with this purchase proposal, it is predicted that direct labor and variable overhead costs will be reduced to 10% and direct material costs will be reduced to 20%. So with the purchase proposal of 90 kobo, direct material, direct labor and variable overhead are expected to reduce to 10%, while direct material to 20%. So if that is the case, I can then come back here. I will say direct material. Okay. So we are told that this will be reduced to 20%. Currently, direct material for the 100,000 boxes, direct material per box is 3 naira. So I will say 3 naira multiplied by 20% because examiner has told you that it should be reduced to 3 naira, 20%. 3 naira multiplied by 20%. So of course, I'll close this. So this will give us 60 kobo, 0.60. We are also told that direct labor, according to the question, direct labor is 2 naira. So this 2 naira, we are told it should be reduced to 10%. Okay. So this will give us 20 kobo, 0.20. Again, I will go back to the question. The next item that I have in the table is total overhead. Pay attention to this, please. Total overhead is irrelevant. Why? Because I explained to you when we had operating statements. In fact, when we did relevant costing, I also mentioned it. There are two types of overhead. We have variable overhead and then fixed overhead. And I mentioned that only variable overhead is relevant. The fixed overhead is irrelevant. So in this question, the examiner has given you total overhead. So total overhead could be anything. Since the examiner is not specific, that means this 1 naira 50 kobo is irrelevant. All right, so I don't need that 1 naira 50 kobo for anything because I only need the variable overhead. So, but in the question, the examiner has mentioned something that variable overhead cost should be reduced to 10%. And you can see that the variable overhead is not given to us. Examiner has hidden it somewhere. It has been hidden somewhere. So an examiner is asking you to reduce the variable overhead to 10%. Meanwhile, it's not given to you. Total overhead is not the same thing as variable overhead. Therefore, you have to think. You have to open your mind. You have to think outside the box. Okay, how am I going to get the variable overhead since it's not given to me? I know that total overhead is divided into variable and fixed overhead. See, I'm not given variable overhead. Then is it possible for me to get the fixed overhead? Yes, according to the question, we can determine the fixed overhead because when you look at the second paragraph of the question, when Wumi was reading the question, I indicated it. In the second paragraph of the question, you are told that, however, 100,000 fixed charge 100,000 fixed charges will be absorbed by the product to indicate fair share of the company's present fixed cost to the new products. Okay, using the estimated sales and production of 100,000 boxes of chop-off as the expected volume. Okay, so if that is the case, your fixed overhead is 100,000 naira at the activity level of 100,000 boxes. So if that is the case, I can see the fixed overhead per box here, which is 100,000 naira. I will just divide the 100,000 naira by the 100,000 boxes. So that will give me the fixed overhead per box. So if that is the case, I already have total overhead of 1 naira 50 kobo. I've also seen in the question the information to calculate my fixed overhead per box, which is 1 naira. Therefore, I can use this information that I have to estimate the variable overhead. So let's go and work it out. Let's go and work it out. This page will be for requirement number A, B, C, D. Then our workings will start from here. So I will come here for the working. Let me write that. Okay. Working number 1. We want to calculate variable overhead. Okay. Why are we calculating variable overhead? Two things. In the question, the examiner has indicated that we should reduce variable overhead to 10%. the variable overhead is not given to us, but we have to scan through the question to see how do we determine the variable overhead. We identify the overhead of total fixed overhead of 100,000 naira at the activity level of 100,000 boxes. So if that is the case, of course, we'll be able to get our fixed overhead to be 1 naira. Then we now deduct the 1 naira from the total overhead of 1 naira 50 kobo. That means we have variable overhead of 50 kobo. So that's what we want to do. So total overhead is 1 naira 50 kobo. Then fixed overhead is 100,000 naira divided by 100,000 boxes. Okay, so this will give us 1 naira. All right, so that means variable overhead will be equal to 50 kobo, 0.50. So this is how you are expected to determine the variable overhead. So now that we have the variable overhead, we can then proceed to calculating to complete our calculation. Okay. So I will then come here, variable overhead. Variable overhead. Working number 1 is 0 points. Before that, we need to reduce it. So examiner has told us that variable overhead should be reduced to 10%. Therefore, 0.50 multiplied by 10%. So this will give us 0.05. Okay, so any other cost in the question? I think that's it. That's it. So at this point, then you determine the total relevant cost. So total relevant cost is 85 kobo. All right, this is total relevant cost of making the tube per box. All right, so examiner is asking you to advise whether Shango Tedo Nigeria Limited should make or buy the tube. Supplier's quotation of 90 kobo is higher than the relevant cost of making of 85 kobo. Therefore, the company should make the tube. All right. I will then say Shango Tedo Nigeria Limited should make the tubes since the relevant cost of making is lower than the supplier's quotation. Relevant costs of making slow down. Let me rewrite this supplier's quotation of 90 kobo. So that's that. Next item. Before I move to the next requirements, if you have any question for me, always raise your hand so that we leave no one behind. Then number 2, What will be the maximum purchase price acceptable to Shangotedo Nigeria Limited for the tubes? Show calculation to support your answer with an appropriate explanation. So let me put this to you. What should be the maximum purchase price acceptable to Shangotedo Nigeria Limited? Yes, if you know it, raise your hand. What should be the maximum purchase price acceptable to Shangotedo Nigeria Limited? Yes. Elozo, yes, go ahead.
It should be the 0.85.
Why? Yes, Elozo, why? Why do you think it should be 85 kobo? Elozo, can you hear me?
We
Talk to me. You are saying something.
said because that is the
Elozo,
cost. Hello, can you hear me now? The network is bad. Can you hear me? I say
go
because that
ahead.
is the that is the cost we arrive at
Go ahead.
while making use of relevant costing method.
Okay. So the reason is because, of course, you cannot see something that costs you 85 kobo. Can you pay more than that? No. Therefore, the reason why we are choosing 85 kobo is because that's the cost of making it. So you cannot pay anything above that. All right. So number B, maximum price. Okay. So you then say the maximum price acceptable to Shangotedo Nigeria Limited is 85 kobo, representing the total relevant costs per tube. Total relevant costs per tube or of making the tube. All right. As shown in the calculation below. As shown in the calculation below. Okay. So you then come here, minimum price. Sorry, maximum price. Let me manage this small table. Or let's go to another page so that maximum price. We have direct material, which is 60 kobo. Direct labor, 20 kobo. We have variable overhead, 5 kobo. When you add it up, we got 85 kobo. That's the maximum purchase price acceptable to Shangotedo Nigeria Limited. Okay. The next item Remember, examiner says you should show your calculation. Don't say because you have calculated this in number A requirement, you just pick 85 kobo. If you pick 85 kobo, you have not shown your calculation. So you have to do this. You have to do this to indicate that you have shown your calculation. All right. Don't be lazy on that day looking for shortcuts. Just pick 85 kobo. 85 kobo is not your calculation. All right. Let's move to the next one. Then requirement number 3. Yes, let me look for one of you. Gloria, Fabino. Yes. Read requirement number 3. Do you have it open at your hand? Gloria. Okay. Let me look for another person. Ayodeji, read requirement number 3 in the question. Ayodeji. Okay. Chidima, Arinzechukwu, read requirement number 3. Elozo, I want, let me, I will
Instead
come
of
back.
sales of 100 bus. Hello, sir.
Go ahead, DG.
Hello, sir. Okay, sir.
Go
Instead of
ahead,
sales of
DG.
100 buses, revise. Am I reading it, sir?
Okay, go
Instead
ahead.
of sales of 100 buses, revise estimate shows sales volume of 125 buses at any volume above 100,000 buses. Additional equipment at an annual rental of 10,000 naira must be acquired. Under these circumstances, should Songote do Nigeria limit show calculation to show support your answer?
Yeah, thank you, DG. Yes, that's that. So examiner is asking you that instead of sales of 100,000 boxes, revised estimate shows sales volume of 125,000 boxes. At any volume above 100,000 boxes, additional equipment at an annual rental of 10,000 naira must be acquired. Therefore, under this circumstance, should the company make or buy the tube? So, all the calculation we have done in 1 and 2 above are basically on 100,000 boxes. So examiner is now asking you that a revised estimate indicates uh, sales volume of 125,000 boxes. And you are told that at any point above 100,000 boxes, the company will incur additional equipment costs of 10,000 naira. So what are you supposed to do in this case? Now, to answer this particular requirement, examiner has told you there is an additional equipment renter of 10,000 naira. That 10,000 naira is absolute value. You know, in 1 and 2 requirements, we use par value. So since you have been told that there's an annual equipment rental of 10,000 naira, that means in this requirement number 3, you have to use absolute value. So in this case, I will then come here, requirement number 3. All right. Yes. Savings or deficits from making 125,000 boxes. Okay. So you compare supplier's quotation for the 100,000 boxes Let me write it. Quotation. So we have 125,000 boxes multiplied by supplier's quotation of 90 kobo. So what do you have there? What's the total cost? Yes. 125,000 multiplied by 90 kobo. What do you have?
112,500.
112,500 naira.
500.
So that's the total supplier's quotation or total supplier's cost. So you compare this with relevant cost of making the 125,000 boxes. So here will be relevant cost of making the 125,000 boxes. So you start from direct material. 125,000 boxes. Direct material per unit, we calculated 60 kobo. So what do we have there? We also have direct labor.
75,000.
Yeah.
25,000.
So here is 75,000. We also have direct labor, 125,000 boxes at 20 kobo.
25,000.
25,000. Then we have variable overhead.
Wait.
125,000 at 5 kobo. What do you have?
6,250.
6,250. So examiner now told you that at any point, at any volume above 100,000 boxes, an equipment renter of 10,000 naira will be incurred. So I would then come here, equipment renter. Let me write this E. Okay. Equipment renter, 10,000 naira. So that's it. Let's add it up. Total relevant cost of making the 125,000 boxes. What's the total?
116,250.
116,250. This is A, this is B. So examiner is now asking you whether the company should make or buy. Of course, supplier's quotation is lower than the relevant cost of making the 125,000 boxes. Therefore, we advise that Shangote Edo Nigeria Limited should make. All right. So Shangote Edo Nigeria.
Did you say make?
Or buy.
Is it make or buy, sir?
Hey now.
Buy.
Make or buy.
You are told in the requirement, you are told that under this circumstance, should Shangote Edo Nigeria Limited make or buy? So our advice is that the company should buy. Shangote Edo Nigeria Limited should buy. Since supplier's quotation, let me write it. Quotation is lower than the relevant costs of making the tubes Okay, so that's our decision on that. Then number last, you are told in number 4 requirement that the company has the option of making and buying at the same time. What will be your answer to requirement number 3 if this alternative were considered? Okay, if this alternative were considered, what should be your answer? Okay. What should the company do? Should the company has the option of making and buying at the same time? What will be your answer to the requirements 3? So examiner is asking you, or you are required to use requirement number 3 as the basis of computation for requirement number 4. You know, in requirement number 3, you are told that the company, instead of 100,000 boxes, a revised estimate shows a volume of 125,000. So you want to calculate on the basis of 125,000 boxes. So the company has option of making and buying at the same time. What should the company do? All right. So who will help us to answer that question? So requirement number 4. Is it 4 or D? 4. So requirement number 4. What should we do? Who is helping us? If you know it, raise your hand. What should we do in requirement number 4? How do we answer that requirement number 4? Yes. The company has the option of making and buying at the same time. So what do we do? Femi, are you in this class? I've not heard your voice today. Femi, let me
Good
scan
evening,
through.
sir.
How are you today?
Um,
Good. All right. So, yes, who will help us to answer that requirement? Aureoluwa, I can see you. Amalola.
Can I try?
Yes, go ahead, please.
Okay, I think it depends on other qualitative factors. So to choose if we can make it, because we look at if we have the what's it called, maybe the technical know-how to make the boxes. So we need to consider all those factors then before we choose.
Okay. All right. That's noted. Any other person who wants to try? Yeah? Who is helping us? Michael has said something, so I need other option. What do we do? How do we treat the requirement number 4? Yeah. Ibrahim Awofe, Joseph Uhere. Ibrahim Awofe, please, after this class or right now, just send me the WhatsApp chat. Say hi to me on WhatsApp. All right, Ibrahim, say hi to me on WhatsApp. Okay. All right, because of time, because I want us to finish this make or buy today. Now, in the requirement number 4, examiner is asking you that the company has the option of making and buying at the same time. What will be your answer to requirement number 3, where you are supposed to produce 125,000 boxes, if this alternative were considered? So since the company has the option of making and buying at the same time, what you are supposed to do is to consider what are the options. First thing first, what are the options available? All right. The company can decide to buy the entire 125,000 boxes from the external supplier. So I can say buy 125,000 boxes. Okay, at what price? 112,500. 500. That's option 1. Option 2, the company can decide to make the entire 125,000 boxes. At what price the company will incur 116,250. Option 3, the company can make 100,000 boxes. Since it is cheaper to make 100,000 boxes at 85 kobo, so the company can make 100,000 boxes at 85 kobo. Let me write that, 85 kobo. So this will give us a total of 85,000 naira. Then the balance of 25,000, the company can decide to buy it. Okay. Then buy 25,000 boxes from the external supplier at 90 kobo. 90 kobo. That's wrong. 90 kobo. All right. So this will give us 25,000 multiplied by 0.9. What do you have?
22,500.
Pardon?
22,500.
22,500. Here is 22,500. So add it up. This will give us 107,500. So this is option to make and buy. Let me write that. Make and buy. Okay, so I would then advise, oh, no space again. So I would then advise that Shungo Tedo Nigeria Limited should make 100,000 boxes at 85 kobo and buy the remaining 25,000 boxes from external supplier at 90 kobo. That's it. That's it. That's what examiner wants you to do. Okay. That's the end of the question. Let me know if you have any question on the illustration that we just solved so that we can move to another one. All right. Okay. So if there's no question, let's move on. Let's have one more illustration under make or buy. And that will be all for today. Let me stop sharing this. Okay. So, yes, this is the last question, the last question tested by ICAN on make or buy. So let's have a look. Let's go through the question together. So who is helping us to read? Let me look at.
Let me read.
Okay, go ahead.
Divine Grace DG Limited currently makes as many units of part 2011 as it needs. The company has recently received a bid from another company KK PLC for making Part 2011. The company will supply 1,000 units of Part 2011 per year at 100 naira a unit. The company can begin the supply and continue for 5 years, after which DG Limited will not need the parts. KK PLC can accommodate any change in DG Limited's demand for the parts and will supply it for 100 naira regardless of the quantity. Should I read the Ayo Ayuba stuff?
Go ahead.
Okay. Ayo
Yep.
Ayuba, the cost accountant, reports the following costs of manufacturing 1,000 units of Part 2011. The following additional information is available. Part 2011 is made on a machine used exclusively for the production of Part 2011. The machine was acquired on January 1st last year at a cost of 120,000 naira. The machine has a useful life of 6 years and zero terminal disposal price. Depreciation is calculated on the straight line method. The machine could be sold today for 30,000 naira. Product and process engineering costs are incurred to ensure that the production process for Part 2011 works smoothly, although these costs are fixed in the short run with respect to units of Part 2011 produced. They can be saved in the long run if Part 2011 is no longer produced. If Part 2011 is outsourced, product and process engineering costs of 8,000 naira will be incurred for next year only. Rent costs of 8,000 naira are apportioned to products on the basis of the floor space used for manufacturing the products. If Part 2011 is discontinued, the space currently used to manufacture it would become available. The company could then use the space for storage purposes and save 2,000 naira currently paid for outside storage. General overheads are apportioned to each department on the basis of direct production labor costs. This cost will not change in total, but no general overhead will be apportioned to Part 2011 if the part is outsourced. Assume the required rate of return is 12%. Required. Should DG Limited outsource Part 2011? What maximum price should KK Limited quote on the 1,000 units to make Divine Grace indifferent between outsourcing and internal production? What non-financial factors would favor internal production rather than outsourcing?
Thank you very much, Chidima. Yes, that is a question. That is a question. Examiner is asking you in the A requirement, should DG Limited outsource Part 2011? You want to know whether DG Limited should outsource Part 2011 or make Part 2011 internally. All right, to answer this, the most important thing you need to do is to compare the supplier's quotation with the relevant cost of making Part 2011 internally. However, there is something that is unique in this question, which is also very strange. And that's why when this question was tested, most of the students failed it. All right, they failed the question because they could not know how they are going to treat the information, some of the information given, particularly the required rate of return given to you, because it was strange. All right, so they didn't know that whether they should use this required rate of return or not. However, whenever you are calculating, and then like in this case now, because you have been given the discount rates, that means you are supposed to discount the future cash flows to the present value equivalent, meaning that you need to establish what are the costs that the supplier's quotation that the supplier will incur on this Part 2011. So you discount the cash flow to the present value equivalent. You keep it on one side. In addition to that, for the if the company wants to make Part 2011 internally, what are the relevant costs that needs to be incurred? Once you establish the relevant costs, all the relevant costs, then you need to discount it also to the present value equivalent. Then at the end of the day, the present value from outsourcing Part 2011 minus the present value of making Part 2011 internally, you will tell you whether you have a saving or a deficit, or whether you want to make it or you want to buy Part 2011. All right, so that is what you are going to do as far as this question is concerned. So without wasting more time, what are we supposed to do? Let's go back to the question and identify all relevant variables. Let me switch, okay? Let me switch to the working note. All right. Solution. Let me see. Yeah, still have space. Solution. So illustration 3, page, I think that should be page 36. Yes, page 35. It started from page 35 to 36. All right, page 35 to 36. Okay, the name of the company is Divine Grace. Divine Grace. So number A, requirements of the question, you have to advise whether DG Limited should outsource Part 2011. So let me give you a short, okay. Number A. This question, let me give you a short note. This question relates to make or buy. However, let me write that. However, since a rate of return, did the examiner call it rate of return or discount rate? Let me check. Yes, since a rate of return of 12% is given, okay, the cash flows from outsourcing, the cash flows from outsourcing Part 2011 and relevant costs of making Part 2011 internally. Part 2011 internally will be discounted to the present value equivalent before determining savings or deficits from making part 2011. Okay, so that's because of the discount rate given to you, because of that, this cost of capital of 12%. So if had it been that 12% is not given to you, so we would have done it the same way we normally do it. Just compare the supplier's quotation with the relevant cost of making part 2011. The difference will give you either saving or deficit. But in this situation, in this circumstance, we can't do that because you have been given a discount rate of 12%. So which means that you need to discount the supplier's quotation. You also discount the relevant cost of making part 2011 internally, all right, to arrive at the present value. So it is the present value, the difference between the present value of the two costs that will show you whether it will result in a saving or deficit. Okay, so that's what you need to do. So that's what I have to add up, this additional information, so that when you are reading on your own, you will know the reason why we are treating it the way we do. All right. So let me see if I can add more to the present value equivalent. So I think that's okay. That's okay. So at this point, the next thing we need to do now is to bring out if you want to outsource part 2011, what are the costs that the supplier will incurred? All right. If DG wants to make part 2011, what are the relevant costs that will be incurred? All right. So let's bring them out. So the first item will be for the outsourcing, okay? If the company, option one, outsourcing, part 2011. Okay, so what are the variables? What are the costs? There will be more than one cost because examiner has given you some information relating to outsourcing part 2011. So let me do it in such a way that will make it more presentable. We can create about three different, okay, let me create a column. Let's put it in column. I will create a column for description, all right, of the cost item. Then I will create a column for the cost. Then if there's any comments or remark, okay, so that you look more presentable. So let's go back to the question together. So we'll be picking any variables that we need one after the other. All right, remember, relevant costs are solved from the additional information. Okay, so the following additional information is available. Part 2011 is made on a machine used exclusively for the production of part 2011. The machine was acquired on 1st January last year at a cost of 120,000 naira. So that 120,000 naira, is it relevant or irrelevant? Based on what we have done previously, let's answer that. 120,000 naira, relevant or irrelevant? Yes. Pardon? Why?
Because is a sunk cost.
It's a sunk cost. It's an historical cost. So that 120,000 naira is not relevant. The machine has a useful life of 6 years and zero terminal disposal value. Depreciation is calculated on a straight line method. So if you divide 120,000 naira by 6 years, it will give you 20,000 naira. Therefore, examiner is telling you that the depreciation of 20,000 naira, of course, they're just explaining how they arrive at the depreciation of 20,000 naira. So depreciation, relevant or irrelevant? we have a depreciation of 20,000 naira. Relevant or irrelevant?
It's irrelevant
Irrelevant.
Why?
because it does not involve cash flow,
It's not
movement
a
of cash.
cash flow. Depreciation is a non-cash item. Therefore, you ignore it. See, in this question, it's not sufficient for you to just say DG Limited should outsource or should not outsource. You have to state your assumption because here you can see we are talking about historical costs. We are talking about depreciation. You have to indicate, you need to give your justification why the underlying assumptions, why you ignore those figures. All right. So we'll move to additional information number 2. All right. The machine could be sold today for 30,000 naira. The machine could be sold today for 30,000 naira. So that's a saving. All right. That's a saving. So let's go and indicate that. Now, if this supplier wants to use this machine to produce, and then they want to sell it today, that's a saving of 30,000 naira. So I will come here. Before I come back to that, okay, let me just put it there. Saving, machine disposal, machine disposal. It's a saving. Okay, let me push this one to the front. Cost will be here. 30,000 naira. All right, because it's a saving, and you remember what you are doing is all about cost. Therefore, now that you have a saving, you put it in brackets. All right, so examiner has told you today. Let me go back to the question. The machine could be sold today. Okay, so that today means because you are talking about time value of money. So because when you are calculating your discount factor, you must take into consideration the number of years. So this one, the examiner has told you is today, disposed today. So put today here so that you know where your discount factor will fall in. Then that's one. Let's go back. Let me see if I can do this. Okay. Okay. All right. Good. So let's go back to the second one. Number 3 requirements. The product and process engineering costs are incurred to ensure that the production process for Part 2011 works smoothly. What this means is that if they don't incur product and process engineering costs, that means there may be disruption in the production process, all right, which make product and process engineering costs to be relevant. Although these costs are fixed in the short run with respect to units of Part 2011 produced, they can be saved in the long run if Part 2011 is no longer produced. If Part 2011 is outsourced, product and process engineering cost of 8,000 naira will be incurred for the next year only. Okay, so let's indicate that. Product and process engineering. Product and process engineering cost, we are told is 8,000 naira. When are they going to incur that? We are told that for the next year only. For the next year only. That means for year 1 only. For year 1 only. Okay. So let me rewrite this one. Today. Today means year 0. All right. It's not clear. Today means year 0. Okay. So all these things matters. You must know how to interpret it. Next one. Yes, number 4. Rent cost of 8,000 naira are apportioned to products on the basis of floor space used for manufacturing the products. If Part 2011 is discontinued, the space currently used to manufacture it would become available. The company could then use the space for storage purposes and save 2,000 naira currently paid for outside storage. So we have a range of 8,000 naira. That range of 8,000, is it relevant or irrelevant? Yes. Talk to me. Range of 8,000 naira, relevant or irrelevant?
Irrelevant.
Why?
It's a fixed cost.
Okay. Now, of
So
course, it is not relevant, but the reason why it is not relevant is because it's an apportioned cost. Apportionment is this cost does not relate to Part 2011. It's because it's an apportioned cost, and that's why we are ignoring that 8,000. It's not because it's a fixed cost, okay? It's
all right,
because
sir.
it is apportioned. All right. Then we are now told that the company could then use the space for storage purposes and save 2,000 naira currently paid for outside storage. That 2,000 naira, relevant or irrelevant? Who is helping us?
Relevant.
Pardon?
Relevant.
Re or ire?
Relevant.
I said re or ire.
Re
Uh-huh. So why? Why do you think it's relevant? It's re?
is opportunity cost.
Is an opportunity cost. Yeah, you are correct. So we have a storage. This, pay attention, please, because you have to be very careful. Because of the required rate of return given to you of 12%, you must determine the number of years for each of the cost item. So this saving of 2,000 is going to be for the period of the contract, for the period of this, which is for 5 years, because you are told that the company could then use the space for storage purpose. You know, you are going to store the Part 2011 in this storage within, in the storage space, all right, for the period of this contract. So what that means is that this 2,000 saving will be for the next 5 years, because you are, according to the question in the first paragraph, you are told that the company can begin the supply and continue for 5 years. All right. So the period of this contract is for 5 years. So I would then come here, storage cost. So 2,000 naira is what I will be saving. That will be saved. That's a saving, 2,000. So for how many years? For 5 years. For the next 5 years. Okay. So that will help us. This comment will help us to determine how are we going to calculate our discount factor or annuity factor, as the case may be. Okay.
Hello, sir.
What else? Let's move. Yes, talk to me.
Okay, yeah, sorry. I have a kind of a break in the network. How do we determine that 5 years, sir? You were trying to explain it when my network cut off.
How do we determine what?
The next 5 years for this savings of 2,000. You were trying to explain it that
Yeah, it's there in the question. You know, your examiner has told you that you have been told in the question that uh, the company could then use the space for storage purposes and save 2,000 naira currently paid
yes.
to outside storage, currently
Yes,
pay for
I saw
outside
it.
storage. So that means it will be for the next 5 years, because the period for this part 2011 will be supplies for the next 5 years. When you look at the first paragraph in the question, examiner told you that the company can begin the supply, that is, this external contractor can begin the supply and continue for 5 years. So that means the period of the supplying period is for 5 years. So you are
Okay,
going to need that storage space for the next 5 years also.
okay. I've gotten what I'm looking for. Thank you, sir.
All right. You are welcome. Then let's move to the last one, the last paragraph. The general overhead are apportioned to each department on the basis of direct production labor costs. When you look at the table, we have general overhead of 10,000 naira. So examiner is now explaining that, telling you that, okay, the general overhead are apportioned to each department on the basis of direct production labor cost. Okay, this cost will not change in total, but no general overhead will be apportioned to part 2011 if this part is outsourced. So in that case, it's already irrelevant since it's not it's not if you outsource part 2011, there will be no general overhead. So that's that. So that's not part of the cost we are going to consider. Now, remain one item, okay? The last item is the supplying cost. You know, the company wants to supply 1,000 units of parts 2011. You are told that the company has recently received a bid from another company, KKPLC, for making parts 2011. The company will supply 1,000 units of part 2011 per year at 100 naira a unit. So supplying costs, we need to include supplying costs. All right, supplying costs. This will be 1,000 units of part 2011 multiplied by 100 naira. So that will give us a total of 100,000 naira. So here will be 100,000. What are the period of the supplying? This material will be, this part 2011 will be supplied for the next 5 years. Okay? So for the next 5 years. Okay, so that's that. So we have identified all the cash flows relating to outsourcing part 2011. Then also, let's identify all the cash flows relating to relevant cost of making the part 2011 internally. Option 2. Option 2. Let's call it, let me go back to the question if there's any indication. All right. Sure. Okay, let's call it internal production. Let's call it internal production. So option 2, internal production. If DG wants to make part 2011 internally, what's the total cost that will be incurred? Internal production. Okay, that's option 2. So in this option 2, what are the relevant costs? All right, this is more straightforward. Remember, we have a format already when you want to determine relevant cost of making. All right, you pick direct material, direct labor, direct expenses, variable overhead, opportunity cost, any other cost that is related to making the component are what you are going to consider. When you go to the question, you can see direct material of 44,000. You pick it, all right? No adjustment is needed. So I will just come here, direct material 44,000. Okay, direct material. If the company wants to produce part 2011 internally, the company will incur direct material for the next 5 years, because this material will be produced for the next 5 years. So here is 44,000 naira. Okay. Not only that, I will go back to the question. We're also given direct production labor, 22,000. Direct production labor. Okay. 22,000 naira. No adjustment is needed. I will go back to the question in case I have direct expenses. We don't have direct expenses, but we are given variable production overhead to be 14,000 naira. Variable production overhead is relevant. Okay. How much is that again? Variable production overhead, 14,000. Also, we are told that both the company will incur product and process engineering in order to ensure smooth production process. So product and process engineering is 8,000. Products and process engineering, 8,000 naira. All right, that's all. The remaining costs are not relevant. The rent, the general overhead, depreciation, they are not relevant. So if I like, I can add up everything. 66, 88,000. This is 88,000. Total relevant cost. Total relevant cost of making part 2011 internally is 88,000. All these costs are for the next 5 years. For the next 5 years that the production of part 2011 will take place. Okay, so if that is the case, we have identified relevant costs. We have identified all the relevant costs that that KKPLC will incur in making part 2011. That's option number 1. Option 2, we have also identified the relevant costs that DG Limited will incur in making part 2011. Ordinarily, what we are supposed to do, if not because of that discount rate of 12% given to us, what we need to do is to just add up all of this. We just add up all of this. We find the net amount, and then again, this one is the total relevant cost of making part 2011 is 88,000. Then we find the difference. All right. Once we know, we'll be able to determine whether it's a saving or deficit. But because you have been given a discount rate of 12%, you cannot do it that way. You need to consider time value of money. Therefore, all the cash flows associated with outsourcing part 2011 and the cash flows associated with internal production will need to be discounted to the present value equivalent. All right. So after this, you'll be able to determine, you now determine the savings or deficits from making part 2011. So all these things that we have done so far, option 1, option 2, these are just to help you. This is not what the examiner asks you to do. This is just to help you determine the variables that you need in your calculation. Therefore, I can then come here. We need to determine present value for outsourcing part 2011. So calculating the present value for outsourcing part 2011. Okay. For some of you that have done cost of capital, that is doing financial management, So this may not be strange to you, how to calculate present value. All right. So yes, we want to calculate NPV. We are going to calculate NPV. So if that is the case, I will then create a column for year, description of items. We are going to have cash flow, discount factor. Examiner has given us 12%. Then we calculate present value. That's the format. Now, we then go back to the cash flow we have identified for outsourcing part 2011. So let's start from the last one, which is the supplying cost. Let's start with the supplying cost. So we are told that the KKPLC will supply for the next 5 years, 100,000 units at 100 naira. Okay, so which of course we calculated 100,000 naira total. So I will then come here. When are you supplying it? For the next 5 years. First thing first, let's write down the variable. I will say supplying cost. Let me indicate the naira sign. Naira, the naira. So supplying cost. Supplying cost is 100,000. When are you going to supply the part 2011? For the next 5 years. So because this 100,000 naira is constant, year 1 is 100,000, year 2, 100,000, year 3, 100,000, up to year 5 is the same 100,000. Therefore, we are going to calculate annuity factor of year 1 to 5. All right. So that's what I was telling you the other time, that all this information under comment, they are necessary because that will help you to determine when you are going to calculate your how you are going to calculate your discount factor or annuity factor. Now, the next item under the supplying cost is, let's consider the disposal, machine disposal, which is a saving. All right. We are told that the machine can be disposed today. Today means year 0. Okay. So there's a machine disposal saving. Put it there. Machine disposal saving. Machine. Or let's say machine disposal. It's a saving. How much is it? 30,000. Because it's a saving, put it in brackets. When examiner told you that today the machine can be disposed of today. Today means year 0. If you are told today, now, or immediately, it's the same thing. Examiner can tell you today, now, or immediately. It means year 0. So here will be 0. I'll then go back there in the table. The next item is product and process engineering cost. 8,000 naira for year 1 only. All right, 8,000 naira for year 1 only. Products and process engineering cost, 8,000 naira for year 1 only. Here you put 1. Okay. Lastly, we also have storage cost. That's a saving associated with storage cost, which is 2,000 naira, okay, for the next 5 years. So I will then come here, storage, saving of 2,000, because it's a saving that will reduce the cost for the next 5 years, because that storage space will be used for the next 5 years. Therefore, the saving will also arise for the next 5 years. So here is year 1 to 5. Okay, so now that we have indicated this, then we need to calculate the discount factor for each year. So I need annuity factor of year 1 to 5 at 12% for the supplying cost. So to get your annuity factor, let me see. Let me push down. Okay, let's use here. Working. For the benefit of you that are not doing FM, so let me show you how to calculate annuity factor. Annuity factor, AF. Now, this annuity factor is computed when you have constant cash flow. When you are given constant cash flow, you need to calculate annuity factor instead of doing it one by one. So when you are doing it one after the other, it's a waste of time. It's better you just calculate annuity factor or cumulative discount factor. Annuity factor is computed as 1 minus 1 plus r raised to power minus n divided by r. The r is the cost of capital or rate of return or discount rates. The n is the useful life. So in this case, we are given the required rate of return of 12%. That means our r is 12%. So annuity factor equal to 1 minus 1 plus 12% will give us 1.12. The supplying cost is for the next 5 years. Therefore, useful life is 5 years minus 5 divided by the discount rates of 12%, 0.12 equal. So you use your calculator to get the answer. Follow through, open to your calculator, let's do it together. All right, so you start from the parentheses, 1.12 raised to power minus 5 equal, then minus 1. The answer you have in your calculator minus 1 equal whatever you have in your calculator divided by 0.12 equal 3.605. So restrict your number to 3 decimal place. You can do to 4 decimal place or 2 decimal place, whichever one that you want, that you think. But I always like to use 3 decimal place. So here will be 3.605. So that's the discount factor. Sorry, the annuity factor. So I can then go there and post. So here would be, for the next 5 years, annuity factor is 3.605. Okay? Then for year 0, discount factor at year 0 is usually 1. Discount factor for year 1. Okay? Let's calculate discount factor for year 1. That's a formula for that one separate. So for discount factor, DF, discount factor is calculated as 1 plus r raised to power minus n. So the cost of capital is 12%. Therefore, discount factor for year 1 will then be equal to 1 plus 12%. That's 1.12 raised to power minus 1. So what do we have here? Bring out your calculator. 1.12 raised to power.
0.893.
Pardon?
0.893.
Okay, that's 0.893. Thank you. 0.893. So that's the discount factor for year 1. Then go and post. So here is 0.893. Of course, we've already calculated annuity factor of year 1 to 5 to be 3.605. So at this point, we need to calculate the present value. To get the present value, you multiply cash flow with the discount factor. So 100,000 naira multiplied by 3.605. This will give us 360,500. 360,500. 30,000 multiplied by 1 will give us 30,000 negative. 8,000 multiplied by 0.893. Okay, 8,000 multiplied by 0.893.
7144.
7144. Here is 7144. Then 2,000 multiplied by 3.605.
7210.
7210.
Negative.
Okay. Let me rewrite that circle brackets. So that's it. So at this point, we need to add everything together. Add the present value together. What do you have? What do you have?
330,000.
You said 330 what?
434.
434.
434.
434. Okay. So 330,434 naira is the total cost of outsourcing part 2011. So that is as per that. The next thing we want to do is to then determine the present value of making part 2011. Okay.
Sorry,
Let's
sir.
see if it.
I'm having a different value.
What did you
Three
have?
four four eight five 344,854.
Okay, let me confirm from my end. Let me see. 360,500 plus 7144 equal minus 30,000 minus 7210. 330,434 is the answer, is correct. So the second part, calculating present value of internal production for internal production. Okay. The same way you have done for outsourcing part 2011 for internal production of parts 2011. Okay. So create a column for year, description of items. All right. We have cash flow, discount factor at 12%. Then we have the PV. All right. So for the internal production, the first item is direct material cost, 44,000. Direct material, 44,000. Direct production labor, 22,000. We have variable production overhead of 14,000 naira. Then we have products and process engineering cost of 8,000 naira. That's it. So all these costs for internal production, they are for the next 5 years. Therefore, you calculate calculate annuity factor. We've already done that. 6.05, year 1 to 5. Year 1 to 5, year 1 to 5, year 1 to 5. Okay, 3.605, 3.605, 3.605. All right, total. So, let's multiply.
Direct material,
Yep,
158,620. 58,620.
158,620. Okay,
Labor,
okay.
9,310.
49,000.
For labor, 79,310.
79,310. Okay. Production overhead.
Production overhead, 50,470.
50,470. All right. Product and process. 8,000 multiplied by 3.605.
28,840.
28,840. 28,840. All right. So let's add it up. Let's add it up.
317,240.
317,240. Okay. Now we have calculated present value. We have discounted the cash flows associated with outsourcing part 2011 and then internal production of part 2011. For outsourcing part 2011, total PV is 330,434. For internal production of part 2011, total PV is 317,240. Therefore, to get the savings or deficits, you need to compare the supplier's quotation with the relevant cost of making part 2011. So I will then come here PV of saving or savings, saving or deficits from making parts 2011. So all we need to do is to compare the supplier's quotation. So option 1, outsourcing part 2011, PV of outsourcing, let me write it. Don't start to. Outsourcing part 2011. We got 330,434. Then PV of internal production of part 2011. We got 317, 240. Okay, find the difference. What's the difference? Supplier's quotation is 330 minus 317, 240.
13,194.
That's 13,194. 13,194. So examiner is now asking you in the requirement number A, should DG Limited outsource part 2011? Should the company make or buy part 2011? So our decision would be that since, you can just say since the PV or since the PV of internal production is lower than the PV of outsourcing part 2011. DG, Divine Grace Limited, should produce or should make parts 2011 internally in order to save or in order to achieve savings, in order to achieve a saving of 13,194 naira. That's it. 10 marks. You can never hang your 10 marks. If you stop here, you have to state your assumptions. Remember, in the question, you have rents. You ignore the rents. You also have depreciation. You ignore the depreciation. You have general overhead. You ignore the general overhead. You have matching cost of 120,000 naira, which we said is an historical cost. You must state your assumption for each of them while you ignore them. Then it is after when you do that that you can hear your 10 marks for this requirement. Okay. So quickly, let's move to number B part of the question so that we can close the class. The number B part of the question.
What you are saying is
I've
that
said already, if you want to talk, you just raise your hand. I don't like being caught unaware. You know, it disrupts me. So go ahead with your question. Talk to me.
I'm very sorry, sir.
It's okay.
What we are saying in essence is that after this, before we go to B, we're supposed to state our assumptions, right?
Correct.
Okay, thank you.
You have to do that. Otherwise, you will not earn your full mark. Because the examiner wants to see you explaining the reason why you ignore those cash flows that you have in the question. If you just go straight, if you ignore them, if without stating your assumption, you cannot earn your full mark. All right. Okay. So number B part of the question, examiner is asking you, what maximum price should KK Limited quote on the 1,000 unit to make divine grace indifference between outsourcing and internal production? 5 marks. What the examiner is saying here is that what is the break-even price, okay, that KK Limited should quote that will make divine grace to be when you are indifferent, that means you are neither here nor there. You sit on the fence. All right. So the divine grace can decide to buy or make it. All right. So examiner is now asking you, what is the maximum price? Right now, the price that KK Limited is quoting is 100 naira per unit of per unit of part 2011. So you are now told that what is the maximum price that KK Limited should quote for the company for divine grace to be indifferent. So what examiner is simply asking you to do is to calculate sensitivity margin of supplying cost. Okay, you are supposed to calculate sensitivity margin of supplying cost. So let's put it down. Number B, like I said, you have to state your assumption for the A2. Assumption will be here. I'm just trying to look at the time. So I don't want to, after this second one, then we can come back to the assumption. I will just explain to you, but let's first of all do the, of course, under the assumption, like I said, we talk about the, you have the matching costs. Okay, number one, talk about the matching costs, which we said is an historical cost, historical or sunk cost. That's why we ignore it. Of course, this is not how you are going to state your assumption. No. You know how we've done it under relevant cost. Then we also have depreciation. We said depreciation is a non-cash item. Non-cash item and therefore not relevant. Non-cash item not relevant to the calculation. Then number three, we have rent. The rent, we said the rent is an apportionment. Rent is an apportionment, therefore not relevant. Apportionment, not relevant to the calculation. Then number four, we also have, what other costs do we have in the question? Yes, general overhead. General overhead. And we said also, this general overhead is not relevant. Okay? This is not relevant because what are we even told in the general overhead? The general overhead of 10,000. The general overhead are apportioned, so it's an apportionment. So not relevant because it's an apportionment. It's an apportionment. Okay. So state your, so this is like I said, on the day of your exam, this is not how you are going to state your assumption. You know how to do it. We've done it severally under relevant costing. All right, so you need to flesh it up on the high level. So I'll just show you this. Then number B now. Number B part of the question, the examiner is asking you, what is the maximum price that KK Limited should quote for the part for supplying part 2011 that will make DG indifferent. So when you are indifferent, so of course you want to know the sensitivity margin. So let me come here, maximum price. Maximum price to quote. Okay. Let me help you. Let me flesh it up. The maximum price, let me write that KK Limited, is it limited or PSC? Let me check. KK Limited, yeah. The maximum price that KK Limited should quote. KK Limited should quote for the 1,000 units of parts 2011 to make divine grace indifferent in the friends we represent or will be calculated, will be calculated as the sensitivity margin, as the sensitivity. Let me write it. Sensitivity margin of supplying costs. Okay, of supplying costs for the 1,000 units. This is calculated as follows. You know, this is an exam question. So it is expected that you would have covered the syllabus A to Z, all right? And that's why the examiner is integrating sensitivity margin into make or buy. Sensitivity margin generally is one of the techniques um, of hedging risk. Okay, so when we get to risk and uncertainty, we are going to talk more on sensitivity analysis. Okay, on sensitivity analysis. So in this case, to answer the question, first thing first, you must determine the percentage change. When you talk about sensitivity analysis, is the sensitivity analysis measures the tolerable extent to which NPV can accommodate any change in variable. Okay, so the variable in this case is the supplying cost. We are saying that what is the maximum that's what is the maximum price or maximum cost or maximum price that KK Limited should quote for part 2011 for the 1,000 part 2011 that will make DG Limited to be indifferent. When you are indifferent, that means you want to break even just in between. You are in the middle. All right, that means you want to break even. No gain, no loss. So you want to break even. And when you want to calculate that break-even cost, simply go ahead and calculate the sensitivity margin. All right, simply go ahead and calculate sensitivity margin. You can see in this question, examiner did not ask you to calculate sensitivity margin. All right, but you must know what you are supposed to do at the right time. All right, even when you look at the solution provided in your Pathfinder, there's nowhere, I'm not sure, I can't remember. It's been so I can't remember whether examiner even mentioned sensitivity margin, but it is implied that when you are asked to do such thing, you need to think outside the box, how you are going to do it. So in this case, we want to calculate sensitivity margin. Okay, so I will then come here, sensitivity margin of supplying costs. Sensitivity. That's not correct. Sensitivity of supplying cost of 1,000 units. Okay. Of 1,000 units of part 2011. So to calculate the sensitivity margin, so sensitivity margin is calculated as, let me write it out in full. Oh, I did not even put margin. Sensitivity margin. Sensitivity. To calculate sensitivity margin is simply net present value divided by the present value of the variable. Variable in this case is supplying cost. So net present value divided by PV of supplying cost multiplied by 100 over 1. We want to know what's the tolerable extent to which the supplying cost could change. What's the tolerable extent to which the NPV can accommodate any change in supplying cost? What if the supplying cost reduced by a specific percentage? Can the saving of 13,000, can the company maintain the savings of 13,194? What if supplying costs increased by a specific percentage? Can we still achieve a saving of, so you want to know What is the sensitivity margin? What's the tolerable extent to which the supplying cost can change that will make NPV to break even? Okay, so in this case, the sensitivity margin of supplying costs will then be equal to, we have calculated our NPV to be 113,194. That's what you calculated. The PV of supplying costs is, when you go back to the question, to our solution, the present value of supplying costs from the KK Limited is 360,500 naira. So present value of supplying costs is 360,500. So here will be 360,500 multiplied by 100 over 1. Give it to me. What do you have there? Yes. What's the final answer?
3.660.
3.66%. So the interpretation of this is that the supplying cost of 100 naira that KK Limited has quoted initially can reduce by 3.66. Okay, so that means this is not the price that the examiner is asking you. This is not the maximum price. What you have done is to just calculate sensitivity margin. So you want to calculate the maximum price. So you want to calculate the maximum price that KK Limited should quote. So to get the maximum price, first thing first, you must calculate the percentage change in supplying cost. How much can the supplying cost reduce further? So you can reduce supplying cost by 3.66. All right, that will make that will make DG indifferent. So let me flesh it up. Therefore, the supplying costs, okay, we need to first of all explain that's our figure. The okay, the supplying costs can reduce or can fall by 3.66% in order can fall by 3.6% in order to make DG divine grace indifferent. Okay, that's not the answer. So I would then say, therefore, the maximum price that KK Limited should quote is, I don't know, I will come back to this, is then representing the difference between the initial price of 100 naira and 3 naira 66 kobo. Okay, so when you, as shown below, or We can just say, okay, as shown below. That's it. So I will then come here, initial price. Initially, KK quoted 100 naira. So the sensitivity margin reduction in price, 3 naira 66. So what's the difference? That would be 96 watts, 96.34. Am I correct? That should be yes.
Yes, sir.
Okay, so I can then come here, 96.34. That's the maximum price that KK Limited should. Therefore, the maximum price that KK Limited should quote, I did not put quotes, should quote is 96 naira 34 kobo, representing the difference between the initial price of 100 naira and then reduction of 3 naira 66 kobo as shown below. So that's that. So this is what the examiner asks you to do for you to be able to earn your 5 marks in the B requirements. That's it. So yes, the last part of the requirements, which is requirement number 5, examiner is asking you, one, what non-financial factors would favor internal production rather than outsourcing? Examiner wants you to state the qualitative factor. Let me stop sharing this so that I can, let me use Golden Book to explain, to briefly within the next 2 minutes to explain this. The time is far spent so that I don't delay you beyond the required time. Okay, let me see. Sure. I believe you already seen my screen. Let me see. Which one is this? Okay. I think it's, yes, this is it, skeletal. Yeah, I want to show you, now these are the assumptions I was just talking the other time, how you are going to state your assumption. You talk about the machine. It's assumed that the machine is owned by KK Limited. However, the original cost of the machine of 120,000 naira is a sunk cost and therefore non-relevant. Okay? Then we talk about the depreciation. Depreciation is a non-cash item and therefore non-relevant to the calculation. Then number 3, talk about rents. The cost of rent of 8,000 is an apportionment and not relevant to the calculation. Therefore, it is ignored. Then lastly, general overhead. The general fixed overhead is an apportionment and will be incurred irrespective of whether or not Part 2011 is produced. Therefore, the general fixed overhead is irrelevant. Okay, then we now talk about the number C part, which is the non-financial factor that the examiner wants you to consider. All right, the qualitative factors will need to be considered by the management of Divine Grace Limited before making final decision. Number 1, you need to ask, do we have the required manpower to manufacture Part 2011 in addition to the existing product? That's the question you must provide an answer for. Then number 2, the management of divine grace, we need to ascertain if there's requisite in-house technical expertise to produce Part 2011. If you don't have technical know-how, there is no need for you cannot produce. All right. Then number 3, internal production may be favored over outsourcing Part 2011 to maintain better quality control to satisfy customer demand. Then number 3, do we have sufficient in-house storage capacity? We are told that the Part 2011 will be stored instead of the company to pay external storage. Okay, so the company will make use of their own internal storage. So you need to consider if the company has sufficient in-house storage capacity that can accommodate Part 2011, 1,000 quantity of Part 2011 for that matter. Then number 5, outsourcing Part 2011 may result in labor disputes, which can impair the reputation of the company if not properly managed. Because if you want to outsource Part 2011, the workers may raise issue that, okay, because once the company outsource Part 2011, that means job may be taken out some workers, and as a result of that, the union may rise up against the company. All right, and that can damage the reputation of the company. Then number 6 that I mentioned here is the fact that the impact of outsourcing Part 2011 on workers' morale, okay, should be considered because this can result in low productivity. Other workers may become apprehensive of job loss. All right, if the company outsources Part 2011, other workers, the workers' morale may be low, and which will negatively impact productivity. All right, so these are some of the factors you need to take into consideration as far as this Part 2011 is concerned. So this is the end of the question. So let me know if you have any questions. Some of you have disappeared. Almost half of you have disappeared. It's understandable. All right. So let me know if you have any questions so that we can close the class for today. Any question for me? Okay. In the absence of no further question, I want to say thank you. By the grace of God, we are going to meet next week. All right, when we shall be doing the third scope of short-term decision, which is a special order. All right, so you can just go ahead and read about special order so that in our next class you already have the idea. Okay, so that's from me to you. I will see you next time by the grace of God. Good night, everyone.
Thank you, sir. Good night, sir.
You're welcome.
Good evening, sir.
All right, take care.